Hi, folks. Do read the disclaimer. And today's episode is going to be just mind boggling. Markets have recently hit a new all time high, and we want to determine which sectors are going to lead the next big rally. Can we do any prediction of any sorts? Can we learn from history how sectors move before markets hit new all time high and what those sectors do beyond the all time high? So we'll try to make some connection of the past history to where we are now. And you must watch this to the end of the video to get a sample of what potentially is likely to happen going forward. So a lot of data crunching is there in this video. I would appreciate if you would subscribe to our channel and give motivation to the team. So Nifty very recently is again at an all-time high, at least in rupee terms, and we've had a 14-month consolidation since the last uh, all-time high we made in September of 2024. Now, what happens inside the market and inside the index uh, beyond the index level itself? So, are all sectors at all-time highs? Of course not. But how are they positioned versus one another when such events are happening? So let's see the situation. So this last, let's say September 24 to November 25 now, in the 14 months that we've had, index is at almost the highest point you can say. Uh, there are few sectors which have done well. So the lines which are above the white line, if you can see, is the Nifty, and these are other sectors that did well, and these are other sectors that did not do so well. So PSU banks, Bank Nifty, Nifty Private Bank, CNX Metal, CNX Services, CNX Auto. These are the indices that have done well. And what has not done well is CNX Infra, CNX Pharma, IT, PSEs, FMCG, real estate, energy, and media. Media being the worst at minus 30% during this period. So some of these sectors, like for instance PSU banks, are already at all-time highs. Bank Nifty already at all-time high, private banks already at all-time high. Now, this divergence that we see within different sectors, how does that translate into reading of a new opportunity in the next cycle? Is what we want to study when we do a deep dive into this data. So for doing this study, we've taken these four consolidation phases. Consolidation phase basically meaning that the market is resting till it makes a new all-time high. So March 15 to March 17, and we've taken just the last 10 odd years. Then pre-COVID to crossing of the pre-COVID level, that is Jan 2020 to November 2020. Then October 21 to June 23, and the last one is of course the current one, September 24 to now, which are the consolidation phases of basically maximum drawdown of 15% or more from an all-time high. So these smaller ones are not consolidation phases; they are part of the rally. So what has happened in each consolidation phase? Nifty has delivered a 30 to 50% rally before entering the next consolidation. So this itself is a very big insight that we have, that whenever we do start to really rally higher from the current consolidation, we can expect a 30 to 50% rally based on the history that we've had. So March 2015 to 17 was 25 months up move of 32%. Jan 2020 to November 2020 up move of 50%, and that is I'm calculating from Jan 2020, not from the COVID bottom. October 21 to June 2023, 40% up move, and we have now September 2024 to November 2025 with 0% up move so far, and a max drawdown of 18% in 14 months. Now the sectors that drove these rallies were completely different each time. So let's see how the leadership changed in every phase. And this is the most important part that you would want to understand out of this, is that after this 25-month consolidation from March 15 to March 17, you had a huge up move in Nifty, a 32% up move from March 17 to December 19. Now these sectors, FMCG, private banks, autos, and financials, these were the sectors that hit new all-time high either along with Nifty or a little ahead of Nifty. And While Nifty took 25 months to break out from this consolidation, FMCG took only 17 months, private banks 18 months, autos 23 months, and financials 25 months. So this is phase one we're talking about. And did these sectors then lead the rally further, for example? So when we look at Nifty private banks, for instance, then it broke out to new highs much earlier than Nifty. The white line is Nifty. And you can see that while Nifty was breaking out to all time highs, private banks already had made an all time high before that. And it continued to do so for a long period of time till Nifty dropped off. So Nifty started its run here, private banks pretty much started the run here, and the gap kept going up. Private banks went up 64% from September 2016 versus 32% of Nifty from March 2017. So Nifty went up 32% here, but uh, private banks went up 64% up there. Similarly, for FMCG, new highs came in 17 months ahead of the 25 months of Nifty. And when we see the percentage returns, FMCG clocked 47% in the run up versus 32% of Nifty. So, what is happening is that some sectors start to move before Nifty in the direction of all time highs, and they continue that delivery of performance while Nifty continues to make all time highs. So, did all such sectors which hit all time high along or with Nifty lead the rally? Let's look at that data now. So these four sectors we had identified which had made all-time highs along or before Nifty, and the sector basically that led that rally were financials, which had moved ahead, private banks 64%, which had also moved ahead, Nifty banking space in general, which has moved ahead, but it had not moved ahead of Nifty. Energy was not there ahead, services were not there, but FMCG, which had moved up, also moved up 47%. So the the correlation here is that stocks sectors that are moving ahead of Nifty in making all-time highs were some of the dominant sectors in the phase when Nifty was making all-time highs. And if you see the list of sectors that did not do well in that particular entire phase, none of them were actually present uh, in the pre-Nifty phase by any significant amount. So marginal, in fact, this is autos has equaled Nifty. It has not really underperformed. So none of the underperformers were really present in the previous segment. Now let's look at the chart here. Here it is telling you CNX Finance, Bank Nifty, FMCG, and Nifty is right here at 35%. These doing well in this period, and pharma, PSCs and PSU banks not doing so well in that period. They were in fact down more than 20%. In the second phase, where we looked at pre-COVID to post-COVID situation of 11 months, and then a 50% move beyond that of the Nifty. Here again, you saw IT and defense do very well in that initial phase, and they broke out after 6 months and 7 months ahead of Nifty in 11 months. So Nifty took 11 months to break out, IT and defense broke out in 6 and 7 months only. And then when you see the entire picture, Nifty went up 50%, but IT and defense went up 286 and 125%. So it becomes again a correlation that sectors that moved ahead of Nifty to all time highs were the biggest gainers in the bigger move that happened post Nifty broke out, right? So you can see here Nifty going up, defense, the blue line is up, CNX IT also up, and some other sectors like private banks, FMCG, not doing so well. Phase three, this is after Nifty started making all-time highs in June of 2023, and there was a consolidation period before that of 21 months. Post that consolidation, we had a 40% up move. So what happened in this phase? All these sectors, whether they were Nifty banking space, private banks in particular, energy, defense did not consolidate. It was already moving up. Pharma, FMCG, metals all did equally or better in terms of Nifty uh, amount of months taken to hit new all-time highs. And you will see significant number of those are present here. Public sector enterprise stocks ran up 155%, defense stocks went up 138%, autos, energy, metals, pharma, PSU banks, all available there, except for Bank Nifty, which did not perform as much as Nifty in the major rally. All others are present here and did outperform the Nifty. So here you can see the chart how the defense really rallied, then CNX Pharma rallied, energy rallied, metals rallied, and there were some laggards also. Now we come to the current phase where we are at the cusp of this consolidation, and perhaps we will move into an all-time high. Perhaps we will take some more time. That, of course, is not known. But let's study what has happened in this 14-month consolidation. So in this last 14 months, let's say Nifty is here, and you see capital market stocks have done the best. PSU banks have done well. Bank Nifty in general as an index has done well. CNX Finance has done well. Private banks has done well. So it is focused towards banking and finance and capital markets and metals as well. Metals have gained 12% and are at new all-time highs. So these are some of the sectors that are making all-time highs right now, while Nifty is not yet there, let's say. So now, as we go ahead, how to ensure that we are in the right sectors for the upcoming rally. So this data has certainly shown you that Nifty at all-time high does not mean that all sectors will be at all-time high. Some sectors will continue to outperform Nifty, some may match Nifty, some will lag far behind, and some will go into deeper correction. So the index will continue to go up while your portfolio does not do so well sometimes if you are in the wrong sectors. So the problem with traditional buy and hold, that market leadership is always unclear. You may like some company, on a bottom up basis, but that sector may not perform, or the sector may rotate very rapidly. See, liquidity coming into new sectors will obviously suck out liquidity from older sectors that are not performing or that are not in flavor. So yesterday's winners becomes tomorrow's dead weight in your portfolio. And most investors, because they don't want to change the portfolio, they don't want to apparently book their gains because they'll have to pay taxes on it, or they may be in loss and they don't want to book a loss. So a lot of these other criteria prevents them from changing their portfolio rather than the entire merit of the fact that whether you should be in that sector or not. So when you do momentum investing, sector rotation basically comes automatically to you. So, as leadership is flipping from one to the other, the strongest stocks will automatically appear in your portfolio because it's a rule based system, and the churn will basically get you into stronger stocks all the time. So you get out of weak sectors and you get into sectors that are improving. And a lot of times, you know, as the sectors mature, the move in the sectors mature and the sectors start to come off. That is when most momentum investors will perhaps move out of those portfolios and kick in, and the sectors where the momentum is starting to kick in. That is the portfolio that will get aligned, with the true leaders of that cycle. So the bottom line here is that sectors that are breaking all-time highs before or along with Nifty often become the next cycle leaders. So for this current cycle, if you go back, these are the current cycle leaders: capital market, PSU banks, CNX finance, private banking, bank Nifty in general, CNX metal. These are the sectors that are likely that if Nifty continues on an all-time high path, then these sectors are likely to do well. Uh, One thing that we've also seen in the past three phases is that every phase is unique. There is no one, two, or three sectors that will lead the market each time. Yes, banking and finance has a commonality in many phases, but more often than not, you will find very unique, like defense had come in the last two times, IT had come in one time. So you will find fresh winners are emerging each time, and churning is not bad. I don't know why people think portfolio churn is something like a something which is not to be done. Churn is always good. If you are turning your portfolio and getting into winners, what is that 0.2% cost that you are worried about? What is that taxation angle that you're worried about? Make money, don't worry about tax. It's rotating into emerging leaders. Our US portfolio went into Nvidia long time back and it made huge money there. But if we were stuck with the idea that no, we don't want to go into AI, we should stay with IT services, then it would not have gone there. So momentum needs to be embraced with open arms. You need to be aligned with strength, and you allow the next bull rally winners to automatically come into your portfolio. So let us know in the comments how you like this data. How do you incorporate sector rotation in your portfolios, if at all? And which sectors do you think will lead the upcoming rally? I'll be watching the comments and certainly will interact with you there. Of course, if you like more content like this, you can join our weekend investing community. A lot of folks are there. You can get premium market insights and you can learn more about momentum investing. There is a form in the description. You can drop your email there and the content will start coming to you. Do like and share these videos if you like the content. We believe we are delivering path breaking content on this channel, and a lot of folks tell us that why is your channel subscription so poor? We are only at 100,000 subscribers. So my request is, do subscribe to our channel. If you're a regular viewer, do share this with your friends and family, and if they find value, they will certainly follow this channel. And of course, watch this other content on your screen for more insights like this. Thank you so much, and I'll see you in the next one. Bye.